Hey guys, in this video, we're going to be covering the secret millionaire wealth building strategy that I'm using and that you can use too. So without further ado, let's get into the video. All right, so this is the secret millionaire wealth building strategy. This is what we're going to be covering today, the buy, borrow, and die strategy. And we're also going to cover how you can put this strategy into action. I'm going to show you from a very high level what it actually looks like. And then I'm going to show you my own portfolio and what I'm actually doing. All right. And then at the very end, I'm going to give you some tips so you don't blow up your own portfolio, right? And you don't put yourself into some serious financial risk, all right? Because if you implement this strategy incorrectly, it could lead to some very negative consequences. And I don't want that to happen to you. So please stick around to the end to get those tips. All right, quick disclaimer here. I'm not a financial advisor or a financial planner. You know, those are people you should probably talk to before you do anything like this. I am just some dude on YouTube that's sharing my own experience. All right, so this is the buy, borrow, and die strategy. So we're gonna go over to Google Chrome, and I'll have this link down below in the description so you guys can read it at your leisure. But basically, the buy, borrow, die, how the rich avoid taxes. It's investing money can help you build wealth, but taxes can take a big bite out of your earnings if you go to sell, right? That's what they mean. Following a buy, borrow, die strategy is one way to minimize your tax liability and preserve more of your wealth. All right, so this is kind of what you hear in the news sometimes. Like Elon Musk, he took out a loan against I think it was like SpaceX or Tesla, of his Tesla shares or SpaceX shares, whatever. So he took a loan against that without having to sell anything, and then he used the money to go buy Twitter. So, you know, wealthy people do this, and it's no secret that you can do this, right? It's written in the tax law. You don't have to be worth a certain amount of money in order to utilize this strategy. You could utilize this strategy if you have something like 100,000 or even 200,000, right? 50,000. But of course, you wouldn't do it with, you know, kind of those 5-digit numbers, you know, like 50, 60, 70,000. You'd probably want to wait until you have a very nice amount of capital saved up or invested, something like maybe 100,000, maybe 150,000. So anyways, let's continue with what this strategy is. So basically what you're going to do is you're going to buy, right? Most of us have access to the stock market. And typically what we're going to do is buy index funds, stocks, bonds, ETFs, those kind of things. Some of us will buy real estate. You know, I'm a real estate investor as well. You know, I also buy stocks, but I buy real estate as well. You know, artwork, fine wine, very doubtful. But the purpose of doing this is to capitalize on the increase in value of those assets over time, right? So when you buy stocks, when you buy real estate, they're going to appreciate over time, right? You want to buy assets that are going to appreciate. That's what's going to make this strategy so powerful, right? So if you bought, you know, let's say $25,000, $30,000 worth of stocks, that's how much money you put into it, but they're worth $60,000, $70,000, you know, because of capital appreciation, then that is good for you. Then you'll be able to implement a strategy like this. All right. So step one is, you know, most people, most investors, what they'll do is they'll go out and buy assets, you know, assets that appreciate over time. And then this is where the secret is, right? They will borrow against their portfolio. They're going to borrow against their assets. So once you bought enough appreciating assets, the next step is to borrow against them. In other words, you use those assets as collateral for the loans, right? So you have this big investment portfolio, right? Worth 100,000, 200,000, whatever it is, maybe even $500,000. And you want to go buy some more assets, whether it's, you know, real estate, maybe you want to buy additional stocks, maybe you want to buy shares in a company, maybe you want to buy something, right? Or maybe you want to buy a home, right? You want to buy your home, right? You basically can take a loan against those assets to go buy more assets or to go buy whatever it is that you want to go buy. Now, the beauty is that you're not selling anything. So you're not going to realize any capital gains tax. And that's what makes this strategy so powerful. You're literally borrowing from yourself to go buy another asset that can either put money in your pocket or appreciate in value. All right. So that is the borrow piece. And unfortunately, this is where we're all going to end up. Doesn't matter if you're rich or poor, we're all going to die, right? That is the one true thing in life, is death and taxes. So the beauty of this part is, let's say you had $100,000 portfolio, right? And then it appreciated over time to $500,000, and then you pass away and you pass this on to your heirs. Your heirs are going to have what's called a step-up basis. So when they inherit this portfolio of $500,000, they will only pay taxes on $500,000 and forward. Now they still inherit the loans, right? And the issues with loans, but what they can do is use, that portfolio that they just inherited and pay off that loan, right? And then they'll still have a sizable portfolio left without being taxed. And this is, again, one of the best strategies that I have found and that I'm using right now. So that's what this is basically. That is what the buy, borrow, and die strategy is. But what does it look like? And practically, how can you use it? So I have this little board set up for you, right? And this is exactly what I'm doing. This is my portfolio basically. All right, so we're gonna start over here on the left side. So, we all work, we all work a job and we all get paid, right? So basically what I was doing was I was having pre-tax dollars go into my 401k, and I was also investing in a portfolio on M1 Finance. All right, M1 Finance is my preferred brokerage. You can go with many others, but you just want to make sure that if you're going to be implementing this strategy, that they offer, some type of way to get a loan from your portfolio. Typically, it's called margin, right? Or you can do a borrow or something like that. But you want to make sure that you check with the brokerage that you're using to see if you can even do it, right? But I know with M1 Finance, it is allowed. You are allowed to do it. So basically, this is what I'm doing. This is my whole setup, okay? And I like this. I honestly was thinking about this, and I came across this strategy just by happen chance. I was listening to just people, like wealthier people, talking on podcasts, and that's when I heard around the same time that Elon Musk was taking a loan against his investments, and I was wondering, how can I do that? How can I take a loan against my investments? And kind of this is how the strategy was born. All right, so pre-tax dollars into retirement accounts, we know that, 401ks, the Roth IRAs, the Roth 401ks, although, for a Roth IRA, it is post-tax dollars, not pre-tax dollars, but, the idea is the same. You're going to have your retirement accounts under your investments portfolio. So then you have other money, right? You're going to invest into a brokerage, or at least I'm investing into a brokerage, and my brokerage is M1 Finance. And I have a portfolio, and I have a little bit of crypto as well. So I have a portfolio of, ETFs, stocks, etc. Although, to be perfectly honest, my portfolio is all REITs, right? Real estate investment trusts. Now, REITs, they produce a dividend. That dividend income, what I do is I usually reinvest it back into the portfolio to create a snowball effect. So as my portfolio continues to grow, because I keep putting money into it, it's going to pay me a dividend. That dividend is going to get reinvested back into the portfolio. So, that snowball gets bigger and bigger and bigger, right? So anyways, as I built this portfolio up and got it, to a sizable chunk, which I'll show you here in a minute, I decided one day to take a loan against it, right? And this is through their program called M1 Borrow. Now, M1 Borrow, when you take a loan against your assets, your portfolio, there's an interest tied to it. So if you take like $100, right now I'm getting charged 7% interest. So I'm not sure what the calculation is, like how they actually calculate it. But I know for $25,000 and this is real, like I took a $25,000 loan, I'm paying like $150 a month, right? So I'm not sure how the calculation is actually calculated, but in M1 Borrow, they tell you exactly how much money that you'll have to pay every month on that loan. So anyways, went to M1 Borrow and borrowed $25,000 against my assets. I didn't sell any REITs. I didn't sell anything. I didn't have to, incur a capital gains during this event. M1 Finance just, here's the money. Loan me the money, right? But the problem or issue with this is that you have to make sure that your portfolio does not fall below a certain threshold, because if it does, they will liquidate your asset in order to cover that loan. So this is why you got to be very careful, and this is why you should only do this strategy if you have a sizable portfolio. All right. So I took a loan against myself using M1 Borrow, and then I went out to buy real estate. All right. I'm a huge fan of real estate. I love real estate. I used to buy just, like physical real estate, like single family homes, duplexes, triplexes, that kind of thing. I've since stopped and have sold most of my properties and moved them all into REITs. But I also buy real estate syndications. And these are, massive, projects. You're talking 50, 100, 150, 200 unit apartment complexes. So I invest in real estate syndications. So anyways, I took that $25,000 and invested into a real estate syndication, right? I bought an additional asset with that. Now this particular syndication is going to be, they had a couple different exit plans. One was, a 2-year refi. So when they refinance, they're going to give me, 70% or hopefully 70% of my money. And meanwhile, I'll still be able to collect cash flow. All right, which leads me to my next point. So I buy assets like a real estate syndication, and the real estate syndication is going to pay me a couple different ways. I'm going to get cash flow. They call them distributions. I'm going to get a return of capital. And a return of capital is whenever a refi event or a refinance event occurs, they're going to give me some of my original investment back. And they're going to go sell the asset in, I think, 3 to 5 years. And I'll be able to recoup the remainder as well as any profit on that. So this is literally creating money out of thin air. I took a loan against my assets to buy another asset that's giving me cash flow, potentially giving me a higher return due to the sale, and I'm going to get some of my initial investment back in between 1 and 2 years whenever they decide to refinance the property. Hopefully the interest rates go low in the next year. If not, it's not going to harm us too bad, but it will probably lower my refi, my return of capital. So usually you get these 3 things with real estate. Even if you were to buy a single family home, you're going to get cash flow from the rents. If you refinance out of the property, you're going to get a return of capital, and you get your profits whenever you go sell it, right? If you reposition that property for a sale. So anyways, up here, so I'm going to get all 3 of these things at some point. And what I'm going to do is, from the return of capital, whenever a refi event happens, I'm going to pay back my loan or pay back enough of it. The other thing, I'm going to have cash flow, and this is going to be the distributions, the rental checks. And what I'm going to do is move that money back into the portfolio. Pretty exciting, right? So I'm going to move that money into the portfolio, and I'm going to continue growing the portfolio. I'm going to continue buying shares of REITs, or it could be index funds, it could be ETFs, it could be, maybe tech stocks, whatever it is, right? And then as I get dividend income from this portfolio that's growing, I'm going to reinvest those dividends. right? So I'm basically creating a cash machine, something that's just always going to be making money. My money is going to make me money, which makes me more money, which I use then to make more money, right? You see how that works? So upon, a sale of the property, I have to pay back the loan or not. I can use the remainder of the cash and reinvest back into the portfolio, which will give me more dividend income, which I can use to reinvest and then buy more shares and then continue growing that portfolio. So that is what this looks like at a very, very high level. All right. This strategy, I've been doing it for about a year now, a little under a year actually, and the strategy does work, but you have to be careful with it. The numbers have to make sense. So when you're doing the borrow piece, there's an interest rate tied to this, right? So for me, for the $25,000 that I'm currently using against my own assets, I'm paying, I think it's 7.25% interest rate or 7.5% interest rate, but that's about $150, right? And the cash flow from this, as well as the dividend income, is more than enough to cover this if I have to pay for it. So the cash flows, I'm actually making, if I recall correctly, I'm making about $30-$45 in actual profit off the cash flow. Now that may not be super sexy or super exciting, but the proof of concept is there. The proof of concept shows that this strategy does work. I'm literally making money from nothing, right? And eventually, once I get my return of capital and profit, then I've really created money out of thin air. It's awesome. And I didn't have to sell anything. And my portfolio is only going to get bigger and bigger and bigger from this. So that is the strategy on a high level. I will try to get this as a downloadable item for you guys who are interested. All right, or you can pause the video and just take a snapshot. But this is essentially what it looks like. All right, so I'm gonna log into my M1 Finance account and show you exactly what it looks like. All right, so I just logged into the portfolio. So as you guys can see, I've been investing in, for quite some time now. But what we're interested in is the borrow, right? So as you guys can see, I have a $25,000 loan and I have $71,000 in credit still available to me. Total, I can take a loan against myself for $96,000. Now, I wouldn't do that, of course, and I'll go into why in my tips at the very end of this video. So hang in there with me, but this is what I wanted to show you guys. So I took a loan, $25,000. I have interest rate here for 7.25%, and this is what I'm paying here. So my projected bill is $151, right? Interest accrued. My next bill date is August 5th. And as you guys can see, let's see. Oh. Huh. Well, I guess they moved it, but they used to show kind of, the bill pays. I think they changed it, or they updated the platform. But basically, anytime I get dividends or distributions from the syndication, from the real estate syndication, I'll be moving that into this brokerage account, and I'll just keep it in cash and then wait for this bill to come up, and then it'll get paid, right? So that's basically what I've been doing. Now, I know some of you are going to want to see the actual portfolio, so let's take a look. So this is my portfolio. It is made up of pretty much all REITs, right? I have some BDCs in here, but it's pretty much all REITs, right? So, I have a full portfolio value of, I think it's like $206,000, net cash flow 151 plus 55. So yeah, it's about 206,000. But right now I'm at a market loss of, 14,000, but I have dividends of 14,000, right? And, but yeah, this is my portfolio. So this is how I'm utilizing M1 Finance to take a loan against my assets so I could go purchase more additional assets. It is such a powerful strategy. So let's get into Uh, yep, the strategy I put into real action. So I showed you guys that. I showed you guys the high level view. So how not to blow up your portfolio. So this I want to spend a little bit of time on, because this strategy, if done incorrectly, can put you into some serious financial jeopardy. All right. In real estate, people will do, HELOCs, or they'll do, they'll take a home equity line of credits against their houses so they can go buy, more real estate. In the stock world, a lot of people, what they'll do is they'll take margin so they can buy, more stocks, or they can take a bigger position in a stock. It's popular with a lot of traders. So the problem with it is that it's what you're buying with that money. If you're going to take a loan against your assets to buy another asset, you need to make sure that that asset is probably a sure thing, right? That it's going to appreciate in value, and that it's going to pay you more than what you took a loan for. All right, so there has to be a profit, like a profit margin, okay? So how not to blow up your portfolio. So you want to buy stocks that you know very well. And see, for me, I have a whole portfolio of REITs, right? I meant to show you this earlier, but I have a whole portfolio of all REITs, okay? These are all broken down into sector, which is one of the reasons why I like M1 Finance, right? So let's take a quick look at cell towers. I got a couple cell towers in here, American Tower and Crown Castle. Let's take a look at another one, apartments. So I know all of these REITs very well. I know what they do. I know how they work. I know how REITs work. I know the markets that these REITs are investing into. So I feel very comfortable with these. And the beauty of, sort of the beauty with this portfolio is that it's been pretty much beaten up over these last couple of years because interest rates rose, so REITs went down, right? The saying is rates up, REITs down. The real estate market in general, or real estate industry in general, has been taking a beating because interest rates have been so high. But this presented buying opportunities, so I kept buying and buying and buying. So once interest rates go down, REITs are going to, in my opinion, they're going to skyrocket. So I'm looking forward to that. But anyways, I trust these companies. These are very safe bets, in my opinion. Very safe stocks, very safe companies, good responsible management. They're not using a lot of leverage. They're not risky plays per se. All right. So you want to invest in stocks you know very well, right? You're not going to take a loan against a portfolio full of very speculative bets, right? You're not going to do that, because if those bets go bad and they go south, they're going to liquidate not only your portfolio, but they're going to call the loan, and then now you're screwed. All right. You want to invest in ETFs for enhanced risk management, something like an S&P 500 index, right? Stocks, they can go down 10, 15, 20, 30% in a single trading day. An index like the S&P 500 index, or even something like QQQ, which tracks the NASDAQ 100, or VGT, which is a Vanguard technology fund, they're not going to go down 15, 20, 30% in a single day, right? So there's safety there, and it's all about risk management. So when you buy ETFs like an index fund, you're actually mitigating a lot of the risk, because you don't have to worry about individual holdings. So this is why my first point is that you need to buy stocks you know very well and that you feel very comfortable taking a loan against, because if these stocks go down, you're going to only shoot yourself in the foot. So again, if you implement this strategy, what I did was, I know these companies, I know these REITs, and I know that I've already bought at the bottom. All right, these are their valuations are like down 30% from their all-time highs, and some of these REITs, they haven't been this cheap since 2000, like 2009, 10, 11, 12. So I've been buying a lot of these REITs. So I feel comfortable doing this strategy now because of the time in the market that we're in, or the cycle of the market. So again, you can invest in ETFs for enhanced risk management. All right. You can even buy something like bonds probably and get away with this. All right. Never use more than 25% of your limit, 50% max. All right. This is something, it's going to be dependent on your risk, right? How much money do you think you can lose, right? How safe would you be? And this is where you have to really understand your portfolio. So I started off with just 25% as a test, right? And I continued buying into my portfolio, kept building it, reinvesting dividends, etc. Right? And now I'm more comfortable to take an additional 25 so I can go buy another asset, right? And invest into another real estate syndication, maybe a down payment for a home, whatever, right? But that is up to you. For new people, I would never recommend you go above 25%, even 20%. But it's all dependent on how comfortable you are as a person. Me, I'm going to be going up to 50%, and I feel very comfortable at that because I know that my REIT portfolio is still beaten down. I don't think it can go down any further, but of course, those are those famous last words. But I also have some mitigation strategies, like keeping a boatload of cash on hand just in case something like that happens. All right. My final point is you want to be absolutely responsible when you're doing this. All right. Debt is a loaded gun. You want to buy assets that you know are going to appreciate in value, right? You've done your due diligence on them. You know they're going to appreciate in value. They're going to provide some type of cash flow or dividend, and that you know there's an exit plan for them, right? You're not going to hold on to it, and then it eventually end up in the dumpster. So that is a big deal. You want to be very responsible. So these are my points. These are my tips. This is the strategy at a very high level. And I hope you guys enjoyed this video. If you did, let me know. If you guys want to join my community, I have a Skool community. I'll put that link down below in the description. And I hope to see you guys in my next video. Peace.